In this video, I'm going to go through 2 ETFs I believe can have a strong second half to 2018. I'm going to walk you through my reasoning, and then you can do your own research and see what you come up with and see if it's something that works for you that you can add to your portfolio. I plan on doing a lot more videos just like this one going forward, so if you like what you see, hit the subscribe button and feel free to make any suggestions for companies or ETFs you might like, and perhaps I could do a video on them. And if you do hit subscribe, don't forget to hit the bell so you can get notifications, as many of these videos are likely to be rather time sensitive. Okay, let's get rolling. The first thing I like to look at is what's happening in the economy. Where is their strengths and where is their weaknesses? And what do we expect to happen going forward? Very briefly and broadly, it looks like the US economy is doing fairly well. GDP is growing at a decent pace, and expectations are that this will continue. Unemployment has been strong and wages have been growing. Here's a chart to see what year-over-year growth looks like for wages, and here's a chart for what unemployment looks like. As you can see, it's getting lower, which supports our economic growth thesis. With a strong US economy as the backdrop, history has shown that cyclical stocks tend to do well in this type of environment. The card that just popped up on your screen is a link to a video we did on cyclical stocks versus defensive stocks. We also have a link in the description below. Okay, so a strong economy will help cyclical stocks. But thanks to a stronger economy, the Federal Reserve is also raising interest rates, which has the potential to present some economic headwinds. I'd like to think that they would only raise interest rates if the economy can handle it. But either way, we need to be ready for what happens when interest rates rise. So who performs well in a rising interest rate economy? Financial companies do. Higher interest rates, they make more money. They make more money, better earnings, better revenue, higher stock price. And this works in our favor because there's been some timely headlines recently supporting our investment thesis. But first, let's talk about retail, which is a cyclical industry. The first ETF I like is XRT. XRT is the S&P 500 retail ETF. Year to date, it's up about 11.5%, and I expect it to keep moving higher during the second half of 2018. Let's take a closer look at some of the details. First, they have 89 holdings. No one holding represents more than 2% of the fund, which is exactly what I was looking for because I believe this will give us a broader exposure to the retail industry. The companies that have contributed the most to this ETF's solid start of 2018 is Netflix, Shutterfly, and TripAdvisor. But positive returns have been fairly widespread, with almost 65% of their 89 companies posting positive gains so far this year. On top of that, I analyzed the Russell 2000 retail companies, and there were 73 of them. Of those 73, about 70% of them beat analyst expectations for revenue. On top of that, the industry is reporting stronger hiring trends compared to the same time last year. That should help the later part of this year. The fee for this ETF is 35 basis points. Not too bad. I also looked at another ETF, XLY, which is a consumer discretionary ETF and only has a fee of 13 basis points. Ultimately, I like our ETF better, XRT, because XRT is equal weighted when they rebalance and XLY is market cap weighted, meaning that the larger companies represent a larger portion of the overall fund. And this has affected their performance. XLY has outperformed XRT year to date, being up almost 14%. But Amazon represents 22% of that fund. If something were to happen to Amazon, or if nothing were to happen and Amazon were to just stall out, this could have a negative impact on that fund's performance going forward. And I personally believe that Amazon seems a bit overpriced at 277 times earnings. Okay, back to the financials and the rising interest rate play. I like XLF. XLF is a financial select sector SPDR ETF. Now in this case, I like the fact that this ETF is market cap weighted. Their largest holdings are Berkshire Hathaway, JP Morgan Chase, and Bank of America. And as rates rise, I would expect each of these companies to perform well. JP Morgan Chase and Bank of America both have strong balance sheets, and they're in a good position for both dividend and stock buybacks. And I'm not sure if you saw any of the headlines recently, but in the Financial Times and the Wall Street Journal, there are articles talking about how the big banks are performing well in the government stress tests. They expect for those big banks to increase stock buybacks and dividends. Now, this financial ETF is a bit more of a value play than the retail ETF was, because as of the close of yesterday, this ETF was down about 1.3% year to date, after accounting for dividends. I think the second half could be much more favorable as the results of these stress tests come in over the next week and rates continue to rise. In the meantime, XLF has a dividend of about 1.6% and their fee is only 13 basis points. Much like the retail ETF, when we look at Q1 earnings for the entire industry, about 65% of all financial firms in the Russell 2000 beat earnings per share in the first quarter. Despite that, XLF has struggled thanks to some of its largest holdings like Citigroup or Berkshire Hathaway or Goldman Sachs. Each of those have weighed on the performance. I expect each of them to do better in the second half of the year, and that should help prop up this ETF. Okay. So I'm going to come back and publish updates for these videos in the coming months to see how they progress. If you have any ideas for investments you want me to make a video on, let me know. Leave a message in the comments below, and I'll see what I can do. And if you like what you saw today, hit the subscribe button, and I'll see you in the next video. Thank you.